There are two main aspects to monitoring the development of inclusive insurance markets. The first aspect considers the diversity and growth of the market, as well as outreach to vulnerable groups. The second aspect considers the investment in the market and commitment of insurers to support the development of inclusive insurance markets. When we are measuring the growth and diversity of markets, we would first consider the number of policies, premium volumes, and growth in premium volumes. These indicators can be subdivided by product type. For example, we would consider personal accident cover separately to hospital insurance cover. We can also subdivide the data by distribution channel. For example, we would consider bank assurance products separately to products sold through the sales agents of the insurer. The diversity of products and providers involved in the market, as well as the range of distribution channels available, also gives an indication of the development of the inclusive insurance market. In terms of giving an insight into whether customers have choice in the markets between products and providers, and whether products are meeting customers' needs. Finally, in terms of outreach, we would consider the coverage of vulnerable groups, or customers who have been previously excluded from insurance markets. So here we would consider the proportion of customers in these target groups who are covered by insurance. For example, we can consider the number of small-scale farmers who have insurance relative to the total number of small-scale farmers in a particular region or a particular country. When inclusive insurance is at a very early stage, there may not be large policy volumes, or we may not see any diversity in terms of products in the market. But we still need to monitor progress towards the market becoming more inclusive over time. To do this, we could assess the commitments and investments of insurers in inclusive insurance markets. So this could be in terms of financial investments, or in terms of dedication of skills or other resources to inclusive insurance. We can also consider the investment of insurers in consumer education or their involvement in working groups for inclusive insurance. Supervisors also need to monitor the impact of any regulatory interventions. And this could maybe be seen in terms of a wider use of alternative distribution channels if regulations supporting alternative distribution channels are issued. These insights can help supervisors to consider what approaches to take in the future to continue to support the development of the inclusive insurance markets over time.